Well, we showed this over the last months, and especially back in the September report, we showed an overlay of the S&P 500 back in 1987, when it had been going up and up, and the price chart just looked lovely. Momentum had built a floor spanning a couple years where the price was going up. There was rising lows, but momentum was making the same low over and over and over again, where it was dropping down, the price was dropping down to its rising three-quarter moving average, and therefore the oscillator showed a repeated drop to the zero line, a flat floor, a structure. No, the pullback, I think, is probably largely spent, if not totally spent. In fact, that was like a week or so ago. If you'll just notice what's going on, like weekly close to weekly close, we're wheel spinning. It's not really going down, down, down. It went down and then it's wheel spinning. When we examine the short-term technicals of silver, like the day-to-day, week-to-week type stuff, it's building a base, which you can't quite see it on the price chart, but on weekly momentum, I can see a clear ceiling that's been built, such that, I'll give you a number, it's tentative right now. You get these silver back above about 48.09 next week. Okay, we'll get one more day this week, okay? And I'm gonna break out of that base. So all you gotta do is spin your wheels here. And I think that's what it's doing. I think it's next to meaningless. I know every time we get one of these, there's a whole crowd of internet analysts that say, I gotta go to $40 or 41 or whatever, and this is this of the that and so forth. And I don't see it. I see it as a pullback buying opportunity. In fact, I'm making a list right now of miners to add to, because I'm shifting not just into silver related, but also the silver miners. As far as upside, the key trigger for us, and we've stated it over and over for the last month or so, has been the spread relationship between silver and gold. Not the net trend or the momentum of silver or gold, but the relationship between the two. Because we've examined back in the past, and when silver goes ballistic, and again, within that 50-year range, which is ridiculous, I'll comment on that in a minute, $50, $50, the surge that got you up to those levels in the final phase of the 79 to 80 bull, or 2010 to 11, where silver went up fourfold in 5 months, or went up 2.5-fold in 6 months, 2010 to 11. The signal that generated that change in silver's verticality was when it broke out versus gold. The spread relationship, not evident on the silver charts themselves. Right now, the spread between silver and gold is at 1.2%. Divide D silver to D gold, express it as a percent. The major breakout level is not far above 1.3%. So it doesn't take too much to blow that spread through a multi-year high. Did anybody, even an amateur technician, if you only looked at the spread chart, you could see the ceiling. You clear that and we're gone. The ballistic tone will change from accelerated price tone that we've had for the last, 5-6 months, where silver went from the 30s up to the 50s, boom, boom, boom. Then it will go into that next phase. And we're arguing that silver is about to do, that's again, waiting on that trigger level, spread silver gold, to go into a new reality. And it's not going to do it incrementally. It's not going to go from here to $150, $200 or something like that in a matter of, a year or so. It's going to do it rapidly. When mistakes are made by a market, the overpricing mistakes or underpricing mistakes, sometimes they're protracted. We see bubble tops sit up there and froth around for a long time, and then finally they fall apart. And you look back and say, oh, gee, I should have known that. Okay. Similar at bottom. Sometimes markets get undervalued, and investors just say, phooey with that market. It's, it's a dog. Don't touch it. And when it wakes up so fast they miss it. That's where I think silver is right now. Anyway, so right now, if I were looking at one single chart, I would say look at the silver gold spread relationship and the momentum of that, which we plot every week in our weekend reports. The momentum of that spread, which requires going from like above 1.2 to 1.32% to be precise, to break out. Momentum of that is already pushing at the breakout levels. And usually momentum will lead a spread chart breakout. So anyway, enough said on that, but that's what I would look at.
Every historic silver moonshot from 1979 to 2011 shared one key trigger: silver dramatically outperforming gold. When that ratio breaks above a certain threshold, prices stop climbing and start launching. Today, that spread sits just beneath its breakout line. Once silver pushes above that technical ceiling, the shift won't be gradual. It could ignite a vertical rally. The setup is now eerily similar to past parabolic phases, when silver prices multiplied within months, not years. Momentum indicators already show pressure building. The fuse is lit. All that's missing is the spark.
When that spread breaks out, it says something's beginning. Okay? It's not saying, oh, it's over. It's saying the race just began. And there's another spread that's very, very important. And that is between the gold measured against the U.S. stock market. And we've run numerous charts on that, especially last weekend's report where we went back to 2013. During that time, 11, 12, and 13, gold peaked and was headed down into a low that ended in late 2015. Well, obviously during that time, gold was underperforming the U.S. stock market because it was really going down hard. And therefore the spread was negative. Gold was underperforming. But since, actually go back 11 years now, but from 2014, that spread chart, when you divide the price of gold into the S&P 500 and express it as a percent and simply plot that chart month to month, has a massive, super clear ceiling on it that you're bumping and bumping and bumping. It's now for the fourth time, okay? Right now, the spread, if you divide gold into the S&P, is at about 58.5% price of D gold divided into S&P 500. If you ever close a month at 60%, you blow that entire structure out and gold breaks out to the upside. This is a fresh signal, which when that occurs, it's not old. It's not saying, gee, I'm in an old trend. It's saying, I've just begun a major asset class shift. Now, when you do something else that we thought we should do in the weekend report, and sure enough, we were glad we did it, we know the S&P is distorted. It's like NASDAQ 100. In fact, you go to the top 5 or 6 stocks in both indexes, and you'll find that those stocks constitute 30% of the entire S&P 500. And you know what those stocks are. AI, tech related. NASDAQ 100, the same symbols, 5 or 6 of them, constitute 50% of that entire index. So they're heavily front-end distorted. When we divide gold into the Dow Jones 30, or divide gold into the New York Composite Index, indexes people seldom look at anymore, we've already broken out. Whereas you've had that breakout. What it says then is that with the exception of those couple stocks, and by the way, look at those stocks today, they're getting hammered. Palantir, NVIDIA, etc., far more than the market. When you lose those leaders and gold breaks out versus the S&P, joining its already existing breakout versus New York Composite and the Dow 30, it's saying there's an asset class shift that just occurred. It's new. It's brand new. And whenever gold breaks out versus the S&P and surges in performance, it always converts into net price gain for gold. So what people are talking about, gee, this has got to be over, it's gone ballistic, etc. Two things are wrong with that. One, the spread is just about to break out versus the major asset category, meaning the game just beginning. And secondly, gold is only fourfold off of its prior bear low. Back into its 79 peak, the 1980 peak in gold, and at the 2011 peak in gold, it had had an 8-fold bull market to get to those highs. We're only fourfold right now. So the game is not over. The game is just beginning. Watch the spreads.
This isn't just a silver story. It's a rotation in global capital. Gold has begun outperforming stock markets such as the S&P 500, the Dow, and broader market indices, signaling an early-stage shift away from inflated equities. When money flees overpriced tech leadership like Nvidia and AI giants, it must find safer ground. Historically, that destination is precious metals. Analysts now identify a structural breakout in gold versus major stock indices, a first clue that investors are preparing for turbulence. When silver joins the move, the next bull market in metals doesn't begin, it erupts.
We've got some trigger numbers below the S&P, percent or so below today's low, and on the NASDAQ that would say, uh-oh, you're probably headed down. Now, not disastrously. We think what's been going on in the U.S. stock market since late last year, in fact, is a topping process. We made our high in January, February for the NASDAQ 100, S&P. We had the headline sell-off, which you don't like. If you're a bear, you don't need a headline. You'll get them later. You know, this bank fails, this company fails. You don't want to hear it at the beginning. So we heard this tariff stuff suddenly became the be-all and end-all of the world. Now it looks like the Supreme Court might sort of push some of that aside, in which case that's not even an issue anymore. Well, let's get it out of the way, because frankly, the reason the stock market would top is not because of some headline, which Trump, of course, tried to solve by saying, oh, I'll give a 90-day delay, and so we had a rally off the April low. But making the new high, for example, in the S&P above the January high, we got another 10% or so above the January high. And now we're slipping off some. We think it's all part of the topping process. The same thing happened in 2000 and in 2007 when the S&P was topping. It made a high, looked negative enough for us to say, get out of this category, dropped, but then came back and made a new high, which was a teaser. Whereas if you succumb to the new high and thought, oh my, the game's on again. No, you were wrong. It was a trap. And in fact, the one in 2007 that made the new high was in October 2007, a few weeks after the Fed, surprise rate cut. So if you bought the Fed rate cut, thinking, oh boy, game's on, you bought the top. Okay. Anyway, I think we're in the same situation now. We're getting a laborious top that spans a year or so of up-down action that's confusing. But it's topping according to our momentum work. When that occurs, money will go somewhere else. And the normal two places it's gone in the 2000, 2002, 2007, and 9 bear market and the stock market were T-bonds and gold, especially gold. Well, T-bonds are dogs. They're not behaving well. They get little rallies, little sell-offs, get a little rally today because stock market's weak, but they're stuck in this range for 3 years. They can't get off the mat. Something's wrong there. We all know what it is, okay? So it leaves you, if the stock market starts to break, where's the money going to go? The one place that's smiling, monetary metals.
Bitcoin and high beta tech stocks have been trading as twins, rising and falling together. But as speculative hype fades, both show alarming technical weaknesses. If Bitcoin breaks below key floor levels, its collapse could drag the NASDAQ deeper into decline. And when risk assets unwind, investors chase protection. Bonds are no longer reliable. Yields, inflation pressure, and policy uncertainty have left fixed income markets stuck and unstable. That leaves one remaining historical safe haven: gold and silver. If equities unwind like they did in 2000 or 2008, the metals market could become the new center of gravity for global wealth.
Well, there's still, you could tell by looking at the hour-by-hour action sometimes of silver and gold versus the S&P, especially silver, because some people connect it only as an industrial metal, and therefore if the stock market goes down, silver must too. Okay. They're making a mistake, okay? But you can see it in the hourly ticks where the short-term traders say, oh, S&P just dropped 5, let's sell silver off, it drops 25 cents, and the game is going on still. It's a wrong thought process, because when you stand back and look at the bigger picture, take, for example, S&P made a high January, February, collapsed into April, 20% drop. What did gold do during that time? It exploded. Not hour by hour, but month by month, okay? So S&P had a sharp, cataclysmic 20% drop. It scared most people, most of that occurring in several weeks of March and April. So it was really, almost crash-like, and yet gold went up. Okay? So people need to rethink that assumption because it will trap them into missing something. Well, we showed this over the last months, and especially back in the September report, we showed an overlay of the S&P 500 back in 1987 when it had been going up and up, and the price chart just looked lovely. Momentum had built a floor spanning a couple years where the price was going up. There was rising lows, but momentum was making the same low over and over and over again, where it was dropping down, the price was dropping down to its rising three-quarter moving average. And therefore, the oscillator showed a repeated drop to the zero line, a flat floor, a structure. When it broke it, it crashed. Didn't even wait around for the end of the month close to break it. It broke it intra-month, gone. Okay. This is the fourth time that Bitcoin since 2023 has dropped down to its three-quarter average. That number this quarter is 101,390. Okay, we've been trading below and above that for the last few days, so we've come down to that structure again for the fourth time. We don't think it'll hold this time. The question is, do you wait for a monthly close below that number? We got a long way to go to the end of November. Or do you maybe assume this time, don't wait, it's not going to hold, just like in 87 for the S&P? That's our assumption. Now, does it have to crash? No, I'm not going to argue that. Crash meaning like 30%, a matter of a week or so. But it's a disastrous number regardless. And, it wouldn't shock me that when you break this, that 3 months later or maybe 3 weeks later, you see that the Bitcoin, which, by the way, is highly correlated to the month-by-month price action of NASDAQ 100, is 30% or lower below where we are now, meaning you could be 70,000, 60,000 or something on Bitcoin. Remember, its recent high was 127. It could cut you in half, much of it occurring rapidly. Now, the problem with Bitcoin doing that, aside from proving to the gold doubters that Bitcoin is an alternative to gold, which it is not, but it's linked to the stock market. Its inhale-exhale behavior since 2021 on Bitcoin monthly bar charts versus NASDAQ 100 is practically an overlay. They look like brother and sister. In fact, we ran those charts and removed the name on the chart and the price scale, and you can't tell the difference hardly. So if that Bitcoin breaks our structure, and it's down to it now, if you break it, credibly, like a monthly close, or don't even go lower than what you've already done the other day, like 99,000. It's likely to have a wave impact on NASDAQ 100 because the same speculative inhale-exhale fever is going on there. And sure enough, when we got Bitcoin getting bashed the last week or so, what's happening to NVIDIA and Palantir? Suddenly, they become weak components of the S&P and the NASDAQ. Watch it. Watch Bitcoin. It's very important.
Silver is the most undervalued major commodity in the world, and the numbers prove it. Unlike gold, most silver production comes as a byproduct of copper, lead, and zinc mining, meaning supply doesn't rise when silver prices do. Meanwhile, demand is exploding. But solar panels, 80% manufactured in China, require increasing amounts of silver. Artificial intelligence, electric vehicles, and battery technologies all rely on silver's unmatched conductivity. Silver has recorded 5 straight years of supply deficit. Prices remain stuck in a 50-year range, while fundamentals leave that reality far behind. This imbalance is a ticking clock.
Even back in, I think it was 79, you got monthly RSI above the what is the overbought level, stayed there for like 5 months. In other words, you should have bought the overbought level because it stayed there for 5 minutes, it exploded. In other words, all the norms get smashed. We have a situation in silver where, for some reason, and one reason may be the artificial suppression of the market by certain banks, maybe inclusion with central bank, I don't know, where it stayed in a 50-year range. You go back and look at copper or lead. We ran those charts a few weeks ago, you go back to the 1970s, and you'll see that they were in a range It's 1970s, 80s, 90s into mid 2000, like 2005 or 6, where they were stuck in this orderly reality, up, down, up, down, up, down. And when they came out of it, literally in a few quarters, they quadrupled in price. These were different times. They weren't doing it together. Copper went up in like 2005, 6. Lead went up in 2007, so it wasn't the same driving force. But they quadrupled in price. And then since then, they've lived in a new zone of reality that's like 4 times the average price of that prior zone of reality. How come silver's still in the prior zone of reality? Look at gold. I mean, where was it in 1980? $850. Silver was 50. Okay, where was it in 2011? 1920. Where was silver? 50. Gold's 4,000. Where's silver now? 48? Okay, what's going on here? We know silver's in great demand by high technology. Solar panel production, Chinese are about 80% of that market. They need silver in the cells. And there's also AI demand for silver. Microscopic but pervasive, okay? It's a great conductor. And we know for 5 years now, the new supply has not met demand. There's been a deficit 5 years in a row. Supply-demand deficit. And we know that when silver price goes up, it doesn't induce necessarily more silver production. Why? Because most of silver production doesn't come from silver mines. It comes from base metal miners who are primarily motivated and focused on getting copper out of the ground or magnesium or whatever. And silver's just marginal to them. Therefore, if silver price doubles, it's not really that much of an incentive for them to produce more. If silver matched lead and copper, it could go to $200. Okay. Now, and also, if you go back and look at 1980 high at 50 or 2011 at 50, and factor in the decay in the money in it, the buying power, the real buying power, the dollar, not the dollar index that's measuring paper versus paper, but the dollar quantity almost doubles every decade. 90% increase in the quantity of M2, Well, if you factored that in, silver would probably be $200 now just to match those highs in real dollar terms. Wouldn't be exceeding them, it'd only be matching them in real dollar terms. So all kinds of things point to the acceleration phase going dynamic into a new reality. And the problem with getting over 50 recently is we surged from a low under 30 in April. Okay, started to come back up in May, and in June got back up to 34 plus, had 2 prior highs at 35, May last year, March of this year. So in June of this year, came back up to 34, headed toward those highs, and momentum said you're going to break out and you're going to explode. It's significantly different than what you've been doing instead of incremental. Well, sure enough, you went from, $35 to 53 in a handful of months? I think it deserves a correction. Plus, when you took out the 50 high, what happened? Every idiot investor out there who thought the 2 highs at 50 were meaningful. Again, nominally they are, but in real terms they're meaningless, real dollar terms. They got sucked in to buy it finally. And so you had latecomers come in at 52, 53, and they bagged them. Good, should have been bagged. They should have been buying silver in the 30s or the 40s or the 20s even. And when they bought high, it created a vulnerable group of people. And so that's a logical place to have finally a correction that you could call a correction. You break that spread out, silver versus gold, and add to the gold stock market spread breakouts, which have already occurred, just waiting on the S&P now for that factor, the game's just beginning. And that's when you see a total change in what you expect and in tonal nature of the markets. Something more like what occurred 79 to 80. And by the way, when we get there to those levels, oh sure, you get a sharp correction maybe, but you're in a new reality. You're not going 150, 200 and come back to 50, okay? You're going to live in a new reality up there. Maybe it's between 150 and 250, I don't know, but it's the main focus right now is that surge, because it should be very dynamic and a place to be you've probably not been in your entire investment lifetime. So game is on, but we're watching those two metrics: gold S&P, silver gold.
The recent surge past $50 shook the market, but it was only a preview. Long-term inflation has eroded currency value so significantly that silver would need to reach $150, $200 simply to match its 1980 and 2011 highs in real purchasing power. When silver decisively clears that psychological wall again, late buyers chasing the move will ignite a final surge. Not a brief spike, but a permanent shift into a new price era. Analysts believe the next rally could redefine the asset entirely. Not $60, not $100, a revaluation, a new normal.